Good morning, everyone. Today's topic that we have taken is cost of capital. As you are also aware, that cost of capital is a major aspect that we have to cover in financial management, because that is going to contribute its utility, its purpose in two major decisions. In the few lectures back, we have also discussed that there are three decisions that are supposed to be taken: financing decision, investment decision, and dividend decision. Cost of capital is going to play its important role in financing decision as well as in investment decision. First of all, we try to understand that what is cost of capital. As you are aware, that company requires capital, and capital is brought in the form of shares and in the form of debts. Shares and in the form of debts. When we talk about share, we have equity shares and we have preference shares. Preference shares, they are preferred over equity. That means the payment out of the profit will be made to preference prior than equity. Equity, they are considered as the owner of the company, who will participate in the overall profitability as well as in the loss of the company itself. That is why they are called as owners. Preference shares, they only participate in profit, but they do not participate in the losses. In the debts, we can say we have bonds, we have debentures, as well as you can say as borrowing. Borrowings here we are taking as long-term borrowing, which can be from any financial institution, from any bank or non-bank, or any supplier also. If the period crosses a year, it can be considered as a long-term borrowing. Means we can say these are the various sources who have made the availability of long-term finance for the company, which contribute in constructing the capital of the company. These are the external sources who have brought the capital to the company. But these sources, they have some expectation. First of all, they expect that their amount should be safe and secure. Along with that, they also expect that liquidity is supposed to be maintained. That whenever they have the requirement of their own fund, then they can get back their money. Along with the safety, liquidity, they also require the profitability. Some enhancement in the amount which they have invested in the capital in the form of shares or debts. That means their expectation, which can also be called as the premium. Like dividend. Dividend is expected from by equity shares. Preference shares, they also prefer that they should get some dividend out of the profit. And these sources, they are in the form of debts. They are interested in getting the interest from the revenue of the company. That means these sources, they have made the availability of fund to the company in expectation that at the end of the financial year, they will get this as the enhancement, as a reward for the amount they have given to the company. That means you can also say that this becomes the major, we can say, benchmark for the company, that wherever the company will try to make the investment of this amount, company will keep in mind that this amount is the minimum amount they should get in return. This whole portion, dividend and interest, this is known as the cost. Cost of capital. Cost of capital. Cost of capital is not the expenditure which the company incur in making the issue of these instruments. Cost is basically the promise which the company has made to the various sources that they will make the payment of interest or dividend every year till the amount is remain with the company. जो हम लोग खर्चे करते हैं शेयर निकालने में या डिवेंचर निकालने में, वो खर्चे कॉस्ट नहीं है, वो तो एक्सपेंडिचर है. Because when we try to make the issue of share, we keep in mind that if we are making the issue of 100 crores of share, then what will be the expenditure in making the issue? That expenditure we will try to keep in mind and try to bring that expenditure as a part of the issue also. कि हमको 100 करोड़ निकालने हैं और कम से कम 10 करोड़ रुपए का एक्सपेंडिचर आएगा, तो हम कोशिश करेंगे 110 करोड़ का हम शेयर निकालें, इससे वो एक्सपेंडिचर भी हमारे पास आ जाएगा. So cost is basically the promise which the company has made. Now, that means we can, this cost of capital is represented with the alphabet known as K. K is known as cost of capital. That means this cost of capital can be considered as the minimum rate of return. I am not saying rate of return. Rate of return is the overall rate of return. I am saying it is a minimum expected rate of return by the company so that they are able to meet out their cost or the promises to the various sources. Cost of capital can also be called as break-even rate. This can also be called as break-even rate, जो हम लोग कहते हैं ना break-even point, कि यहाँ तक तो हमको देना है वापस, इसके ऊपर जो भी आएगा वो कंपनी का बेनिफिट ऑफ हो जाएगा. This can also be called as standard rate. Standard rate that we can say. This can also be called as target rate. These are the all other names of cost of capital only, which can also be called as cut-off rate. Also called as hurdle rate. I am just trying to name out all the names so that in different books they try to represent in different ways. But the concept, the meaning remains the same, that it is cost of capital only, the minimum rate of return. Now, that means when the company is trying to generate the capital, then on that capital, this will be the expectation by the various sources. That means if this is cost of capital, then this can be called as cost of equity. This can be called as cost of preference. And all these three, they can be called as cost of debts. Or you can say individually also cost of bond, cost of debenture and cost of borrowing. And combination of all the debts can be called as cost of debts. That means when we combine all the three, that is equity, preference and debt cost, it will be called as overall cost of capital, which will be called as overall cost of capital, or which can also be called as WACC, weighted average cost of capital. It is weighted cost of capital, but I am saying WACC, that means weighted average cost of capital. That means, as you are aware, the amount of dividend fixed for equity will not be remain the same for preference or the interest amount of the debts. That means the expectation by equity shareholders, expectation by preference shareholders, and expectation by debt holder is different. The reason being, the expectation will always depend upon the perception of the risk by the individual. That means, what is the perception of the risk by these individually, and what is the perception of the risk by risk and return by the company. That means I'm trying to say that how we have derived this. Debt holders, they are aware that the company will get the sale. From the sale amount, the various variable and fixed costs are deducted, and along with that, interest is also considered as a fixed cost, it will be deducted. That means they will have the prior hold on the revenue which the company is going to generate in terms of sale. That is why their risk percentage is lower as compared to others. So their amount of interest will be lesser as compared to them. So their risk perception, the risk return is different, is lower. Preference shares, they will get the amount of dividend only when the tax has been paid. All the liabilities, all the accountabilities have been paid, tax have been paid. From the remaining amount now, the dividend has to be given to the preference shareholder. That means their risk has increased. That means their expectation will also increase as compared to debts. But when we talk about the equity share, they do not have any promise of the dividend. They may or may not get. If the company gets the profit, and after making the payment of preference and debt amount is left, then they will pay. So in this way, they are having the highest risk. That is why their amount of dividend will be higher as compared to the other two sources. So what I am trying to say, that expectation of the dividend or interest by the individual will depend upon two aspects. From the individual point of view, it is the risk perception by the individual. From the company point of view, we can say risk and return of the investment which the company is going to get. Means ये पैसा कंपनी कहीं लगाएगी, उस पैसे उस लगे हुए इन्वेस्टमेंट में या फिर अपॉर्चुनिटी में जितना भी रिस्क एंड रिटर्न का इन्वॉल्वमेंट होगा, दैट विल बी द रिलेशनशिप वी कैन से. So these are the various names and concepts. That means if we want to calculate the overall cost of capital of the company, then we have to calculate cost of equity, cost of debts, cost of preference, and then we go for providing the average to each and every, and then we take the average and we get the overall cost of capital. Weight has to be given, reason being we have to equate all the three, because they are different on the basis of the perception of risk, amount they have brought, and the duration for which they have brought. तीनों का अमाउंट बदल रहा है, तीनों का ड्यूरेशन बदल रहा है, और तीनों का रिस्क परसेंटेज भी बदल रहा है. So that is why these three costs will be varying. But with the help of some mathematical equation, we will try to give some weightage to them, the proportion to them. Weight here means proportion, that what is the proportion of risk the individual is bearing. On that basis, we try to calculate, we give the balance to them, and when we take the average, we can get the overall cost of capital. Now, when we talk about that, what is the purpose of this? That means, purpose that comes in the investment. That whatever the investment proposal that we are trying to take up, whatever the investment proposal we are trying to take up, that investment is going to have some return. That investment is going to have the return. Now the role of cost of capital is that we will always expect that return should be greater than cost of capital. That means this will be our decision making aspect. That cost of capital will help the manager to take a decision whether that investment is feasible or not. Because if it is higher, we accept the project. But if the return is less than K, we reject the project. But if the return is equal to K, we can say it is indifferent. Indifferent means no profit, no loss, company may or may not take. If the company is having more than one project, then one project the company can take at indifferent aspect also, in expectation that the company is going to get the profit from the other investment opportunities. What are the decisions that we can say? The cost of capital we have calculated here. You are also aware that whatever the future cash flows we are having, future cash flows means they are the amount that we are supposed to receive in near future. And we have discussed the concept of time value of money. And we are aware that when we get the future cash flow, we try to make the application of present value. Means we try to calculate that what will be the present value of the cash flows. That means we try to discount. So the discounting factor, the discount rate that we take, the discount means at what rate? You must have seen the numerical that we have taken up. In that we take the present value interest factor, 10%, 11%, 12%. From where it has been derived? It is nothing but it is the cost of capital only. The discounting rate that we used to take up in bringing the present value of the investment proposal, that discounting rate is itself the cost of capital. So we can say that cost of capital is also called as discount rate, or here itself we can say that this is also called as discount rate. Discount rate which help to calculate the present value of the cash flows from the investment proposals that we have taken up. Suppose we have taken up a project of rupees 10,000 and every year we are getting rupees 4,000 for next 5 years. That makes 20,000. So you can say we have invested rupees 10,000, every year we are getting 4,000, and that means at the end of the 5th year we get rupees 20,000. So as a layman you can say that 10,000 is the profit, 50% is the profit. But the economists will say that now this 20,000 they have to be converted into their present value. Because 10,000 is invested is today, and the return we are getting every year. That means time value of money says the value of money depreciates with the passage of time. So 20,000 has to be reduced to calculate the present value. For reducing we apply the discount rate, and discount rate is what? The cost of capital. So first I said that discount rate, although we are discussing this discounting rate, that cost of capital in the financing, but it is helping the investment proposals also, investment decision, number one. Investment proposal. Number two, financing decision. Financing decision.